Right now, the global financial system is standing at a turning point, and at the center of it all is one question investors can't stop asking. Is the Federal Reserve about to reshape global markets with its next move? Every major shift in modern market history has one common trigger: a change in U.S. monetary policy. When the Fed speaks, markets listen. When the Fed moves, the world reacts. And this time, the decision could define the direction of global capital for years to come. To understand why this moment is so critical, we need to look at where the U.S. economy stands today. After one of the most aggressive interest rate hiking cycles in decades, inflation has slowed, but it hasn't disappeared. At the same time, economic growth is cooling, consumer spending is becoming more cautious, and corporate earnings are facing pressure from higher borrowing costs. The Fed is now walking a tightrope between protecting economic growth and preventing inflation from resurging. This is what makes the current situation different from previous cycles. Cutting rates too early could reignite inflation and damage the Fed's credibility. Keeping rates too high for too long could slow the economy into a recession. Every word from the Federal Open Market Committee is being analyzed because markets know that even a small shift in tone can move trillions of dollars across global financial systems. In the U.S. stock market, expectations around the Fed are already shaping investor behavior. Historically, when the Fed signals a pivot toward rate cuts, equities respond positively. Lower rates reduce corporate borrowing costs, support higher valuations, and encourage investors to move away from cash and bonds. Growth-driven sectors such as technology, artificial intelligence, and innovation-focused companies tend to benefit first. However, if the Fed delays easing due to stubborn inflation, market volatility could increase, especially in highly valued stocks. Beyond Wall Street, the Fed's influence becomes even more powerful. The U.S. dollar sits at the core of global trade and finance. When U.S. interest rates remain high, capital flows into dollar-denominated assets, strengthening the dollar and putting pressure on other currencies. Emerging markets feel this impact the most, as stronger dollars make debt repayment more expensive and reduce foreign investment. A Fed pivot toward rate cuts could weaken the dollar, offering relief to global markets and triggering capital rotation into international equities. Bond markets are also flashing important warning signals. U.S. Treasury yields reflect expectations about inflation, growth, and future Fed policy. If the Fed begins easing, long-term bond prices could rise sharply, rewarding investors positioned ahead of the shift. But if inflation surprises to the upside, bond markets could experience sudden corrections. This uncertainty is why bonds, once considered predictable, have become one of the most closely watched asset classes today. Commodities add another dimension to this unfolding story. Gold has historically benefited during periods of lower real interest rates and monetary uncertainty. If the Fed signals a more accommodative stance, demand for gold as a hedge could increase. Industrial commodities such as oil and copper depend heavily on global growth expectations. If the Fed's move suggests economic stabilization rather than contraction, demand-driven assets could regain momentum worldwide. Even digital assets are being influenced by Fed policy, whether directly or indirectly. While cryptocurrencies operate outside traditional banking systems, they remain sensitive to liquidity conditions. When interest rates fall and risk appetite rises, speculative assets often see renewed inflows. A Fed pivot could support digital markets, while prolonged tight monetary policy may continue to pressure high-risk investments. So what should investors be paying attention to right now? Inflation data remains critical, especially core inflation trends. Labor market signals such as wage growth and unemployment claims are equally important, and perhaps most crucially, the Fed's communication itself. Markets often move not on what the Fed does, but on what it signals about the future. A single sentence change in a policy statement can reshape expectations overnight. The key takeaway is this: the Fed's next move is about far more than interest rates. It's about confidence, liquidity, and global capital flow. It will determine which sectors lead the next cycle, how currencies behave, and where opportunity emerges. Smart investors are not waiting for confirmation. They are preparing scenarios, managing risk, and positioning strategically ahead of the decision. History shows that major market shifts begin quietly, long before headlines catch up. They start with policy changes, spread through financial systems, and eventually reshape global trends. Whether the Fed cuts, pauses, or holds firm, one thing is certain: the next move will leave a lasting imprint on global markets. And those who understand the signals early are the ones positioned to benefit when the cycle turns.